If you're over 65, Congress created a brand new tax deduction worth up to $12,000. But here's the problem. Many seniors who qualify are going to miss it entirely, not because they didn't qualify, but because they make one of 5 very common mistakes. And what's scary is your tax software or even your tax preparer may not catch it. So in this video, I'm breaking down the 5 biggest mistakes people are already making with the new senior deduction and exactly how to avoid them so you don't leave thousands of dollars on the table. Now for tax years 2025 through 2028, there's a brand new federal tax deduction specifically for Americans aged 65 and older. Eligible individuals can claim up to $6,000. Married couples where both spouses qualify can claim up to $12,000. Now, this is a temporary deduction, only 4 tax years, but it's one of the largest senior-focused tax breaks we've seen in a long time. And as a CPA, I can tell you this always happens when new tax laws roll out. Huge opportunities and, unfortunately, equally huge mistakes. A lot of people will technically qualify for this deduction, but because they misunderstand the rules, they either underclaim it or miss it entirely. So let's walk through 5 of the most expensive mistakes I'm already seeing and how to avoid every single one of them. Mistake number 1, misunderstanding the income phase-outs. This is the biggest mistake by far. Many people hear there's an income limit and immediately assume, well, I probably make too much, or I guess this doesn't apply to me. And that assumption alone could cost you thousands of dollars. But here's how the rule actually works. The deduction starts to phase out once your modified adjusted gross income exceeds $75,000 if you're single, or $150,000 for married filing jointly. But this is not a cliff, it's a gradual phase out. And the deduction is reduced by 6 cents for every dollar your income is over the threshold. So an example, let's say Bob and Mary are both 68 and filed jointly and their modified adjusted gross income is $160,000. So they're $10,000 over the limit. Most couples would stop right there and assume they get nothing. But here's the math. $10,000 times 6% is only a $600 reduction. So they're still going to qualify for $11,400 deduction. Now that's still a massive tax break. And here's the key point most people miss. The deduction doesn't fully disappear until your MAGI reaches about $175,000 for singles and $250,000 for married couples. So if you're anywhere near these thresholds, don't guess, do the math. Phase outs aren't cliffs, they're traps. And come back, I'm going to do another video in a couple weeks on this. But this is very important, and there's going to be a huge opportunity for the seniors who are proactive in their financial advising and tax planning to work on getting their modified adjusted gross incomes down below. There's a lot of opportunity here, so go ahead and hit the button, subscribe. I'm going to bring that to you later, and there's a lot of value there that you can really take advantage of this over the next 4 years. Now, continuing on, mistake number 2, married filing separately. This one's going to catch a lot of couples off guard because they're used to doing it. But if you're married and you file married filing separate, you're not eligible for this deduction, period. There are some situations where that may make sense. For example, when one spouse has very high medical expenses. But when it comes to this new senior deduction, the rule is crystal clear. Let's say John and Susan are both over 65. Years ago, their tax preparer recommended filing separately, and it's just become a habit. They hear about this new $12,000 deduction, and they assume each of them can get $6,000 on their own return. But that assumption is wrong, and it's a $12,000 deduction mistake. And $12,000, depending on your tax bracket, could be $4,000, $4,500. It could be a big tax mistake. Now, if you want this deduction as a married couple, you must file jointly. Now for the years 25 through 28, it's absolutely worth running the numbers both ways. We want to look at both filing jointly and claiming the deduction, filing separately and giving it up. And in most scenarios, at least in our part of the country, the deduction is going to outweigh any benefits from filing separately. Now I know certain parts of the country, because of state laws, a lot of times you guys file separate, but this year, I think you're going to want to make sure you run the math. Now, mistake number 3, forgetting this deduction stacks. This one's subtle, but incredibly important. Many seniors think this new $6,000 deduction replaces the existing extra deduction for being over 65, but it doesn't. This is an extra deduction that stacks on top of what you already get. So let's take a look at that. For a single senior in 25, the standard deduction is $15,750. Because you're over 65, you get an additional $2,000. But you also get an additional $6,000 senior deduction. That gives you a total potential deduction of $23,750. For a married couple where both spouses are over 65, this total is going to be almost $46,700. And this is a game changer. For many retirees, deductions at this level could significantly reduce and maybe even in some cases eliminate the taxation of Social Security benefits and other income. But this is not a direct deduction against Social Security, so don't misunderstand that. Now, mistake number 4, thinking you lose the bonus if you itemize. This mistake is going to lead a lot of people to choose the wrong deduction. Some seniors are going to assume if I itemize, I lose the $6,000 bonus, and that's not true. This is different. You get this deduction whether you itemize or take standard deduction, so this is going to be like a win-win. And here's why this matters. Another example, David, 68 and single. He has $20,000 in itemized deductions. He sees that the total standard deduction with the bonus would be $23,750 and assumes he should take the standard deduction. But that's the wrong comparison. The correct comparison is this. Itemized deductions, $20,000. We're taking that because remember his standard is only $17,750. And since $20,000 is higher, he's going to take that. And then he's going to get the $6,000 bonus senior deduction on top for a total of $26,000 instead of just $23,750. A simple misunderstanding, but that could cost him an extra $2,000 deduction. Now, number 5 is getting the age rules wrong. This one causes both overestimation and underclaiming. To qualify, you must be 65 or older by the end of the tax year. For married couples, each spouse qualifies individually. If only one spouse is 65, then you only get one $6,000 deduction, not the full 12. So if Frank is 66 and Ellen is 64, they don't get the full deduction yet, even though they filed joint. So be careful on this one. However, on the flip side, if you turn 65 on December 31st at 11:45, you still qualify for the entire year. You don't have to wait. So conclusion, let's recap the 5 mistakes to avoid. Number 1, assuming income limits disqualify you without doing the math. And like I said, we're going to do more on this one. This one is critical, you understand. There's going to be so much planning opportunity the next 4 years for seniors. Those who understand that are going to save a lot in taxes. Those who don't are going to miss a golden opportunity. Number 2, filing married separately. Be careful with this one. Number 3, forgetting this deduction stacks on top of existing ones. Number 4, choosing the wrong deduction method when itemizing. And number 5, misunderstanding the age requirements. This deduction is only available for 4 years, 25 through 28. If you didn't get 25 right because you didn't understand some of them, especially point 1, we can fix it for the next 3 years, so don't just take it. However, if you avoid these mistakes, you can keep significantly more of your money instead of sending it to the IRS. So if you found this helpful, make sure you subscribe because these tax rules are changing fast and most people don't hear about them until it's too late. And do me a favor, share this with a parent, grandparent, or friend over 65. This is exactly the kind of deduction people miss. And as I said already, I'm going to put out another one that's going to show you exactly how to take advantage of this to make sure you maximize this deduction. So with that, we'll see you next time.